Hi, everybody. So, depending on your time zone, good morning, good afternoon, good evening. Thank you for attending our session today. I want to welcome you to our topic, which will be on PE valuation updates. I am joined this morning, today, with Eric Rechtschaffen, the Valuations Controller for Sculptor Capital Management, and Joey Malagon, a managing director, and myself, Janetta Mason, who are both in the portfolio valuation group of Duff and Phelps, a Kroll company. So today we will be addressing some insights on the history, current times, and the outlook of PE valuations. Just a quick housekeeping note. We would love to hear any and all questions that you have. So I think at the bottom of the screen, there's a Q&A box. You can enter in your question. We will see them come through. And unless it's a technical question, which we will try to address immediately, we'll hold most of the questions until later in the session. So I guess with that, let's go ahead and kick it off with a little bit of a look in our rearview mirror. We'll start off with the history. And Eric and Joey, how do you feel the evolution of the valuation due diligence process has looked over the past decade?
Yeah, thanks, Janetta, and good morning, good afternoon, everyone. Maybe I'll take a stab at this first, and then Eric, please feel free to comment as well. But maybe I'll try to address the question by sort of commenting on some of the changes in industry practices that we have seen over the past, say, 5 to 10 years. And as investors have certainly been, and I would say continue to be, a driving force behind the evolution of industry practices related to fair value and fair value reporting. I think I would highlight three key areas. The first, the level of rigor that goes into a valuation analysis in the context of private investments has evolved substantially over the years. It wasn't really that long ago when it was considered standard practice for private equity managers to rely on a single methodology to value their portfolio, for example, a multiple of EBITDA. Or in the context of valuing private credit, there was a time when it was common to simply hold investments at par so long as the instrument was covered from an enterprise value or asset value perspective. But over time, we've seen valuations and the underlying methodologies and support become increasingly more robust, and it has become best practice to consider and apply multiple methodologies and look to a reconciliation of those methodologies in arriving at an ultimate conclusion of value. Second, there's been a continued and increasing focus on ensuring an appropriate level of independence in the valuation process, and whether that be internally at a fund to ensure that proper controls are established in order to minimize, for example, potential conflicts of interest, to engaging a third-party valuation firm as an additional layer of independence. And I think one of the trends that we have seen in our role is that we are increasingly being asked to enhance our scope level as an extension of the fund's internal controls process. For example, in terms of customizing report deliverables that might aid in the GP's own reporting process, to providing support through the audit review, even to working with certain GPs to design a more fully outsourced valuation function. And maybe the last point that I would make is that the timing and frequency of valuations has shifted. And in some cases, the shift has been pretty dramatic. Maybe hitting on frequency first, there was a time when it was more typical for a private equity portfolio to be revalued maybe just once annually or semi-annually, unless the manager had a public filing requirement. But today, that standard has largely shifted to a quarterly cadence. And then from a timeline perspective, we've also seen a shift forward to a point where today many of our quarterly assignments, for example, begin several weeks prior to the quarter end date. And I think this shift has really led to more timely reporting to the investor base on the back ends, who obviously in turn have their own reporting requirements that they need to fulfill to their beneficiaries. And so I think each of these trends has certainly helped to improve the overall quality and maybe the usefulness of the reporting that investors typically receive, both during that initial due diligence phase and thereafter during ongoing portfolio monitoring.
And Joey always has such fulsome answers. It's very, very difficult to follow up. But just to echo, and then a few things that we've noticed on our end as well. My experience in valuation is only about 6 years, so it doesn't extend quite as far back as Joey's. But even in that relatively shorter period of time, I've seen a tremendous change. I think that LPs just have an expectation of rigor. As Joey mentioned, that has just increased over time. I see that in our valuation due diligence calls that we now have on an annual or even more frequently than annual basis, where it's no longer just, so tell me a little bit about your process, 5 or 10 minute discussion, it's over. We have incredibly long and detailed discussions where we'll review our valuation day materials with people. We'll go into a tremendous amount of detail about how we're looking at different types of investments, even things like where we're getting our leveling. People really want to understand the details now of how we're looking at investments, exactly how we get there on our valuation. They want to go through examples. It's no longer just a sort of a high-level process like you may have had in the past. In addition, I would say the AICPA guide, which came out a few years back at this point, has also created a bit of a change in how people look at valuation. As Joey mentioned, it used to be much more common to hold debt at cost, right? Or to only look at one methodology. Whereas now, thanks to the AICPA guide, in addition, obviously, to whatever waterfall analysis might have done to see where the value would be at your particular tranche or level within the cap structure, there's an expectation that you're going to look at multiple methodologies. And I think that's probably good overall for the industry because it shows that people really do, put a lot of thought into how their analysis works. And on the question of independence, which I think is part of it, obviously, utilizing third-party managers is quite important, and Sculptor obviously does utilize third-party managers in our process. But in addition to that, we have found that things like the composition of the valuation committee can actually be quite important. The independence from the front office in order to ensure that people are getting the most objective values that they can is something that I think investors really do appreciate. And they find it to be important to know that there is an independent body both within the firm as well as that external third-party reviewer that's going in and making sure that the values really do represent the best estimates per the valuations team at the firm, as opposed to simply being what IPs might, want them to be, which is something that we obviously take very seriously at our firm, and I know across the industry has become much more of a focus. So there certainly has been an evolution, even in the relatively shorter time that I've been in this industry. But I certainly have noticed that the demands from the LP community have continued to evolve as LPs have become ever more sophisticated, and my expectation is that's going to continue.
Thank you. That's excellent. And then now, as we turn to the current landscape, maybe discuss what are some of the current challenges that your evaluation process faces today, and how you're seeing those addressed.
Sure. So maybe I'll kick this one off again, Eric, but please feel free to jump in. So I think one challenge that we see relates to increasing levels of complexity in certain investment structures that we are seeing today, and whether that's in the VC space, where you're often finding portfolio company capital structures with multiple tranches of preferred equity, for example, where each tranche has its own unique economic rights and preferences, or even in more traditional private equity portfolios, where it's also becoming more common to see structuring and more complex equity type securities. As you add complexity, of course, to the terms and features, more likely than not, that's going to bring in additional complexity when it comes to valuing those instruments on an ongoing basis. And for many years, there was, I think, a lack of consensus across the industry in terms of how to value these types of more complex instruments, more complex capital structures, where on one end of the spectrum, you had certain market participants applying more detailed mathematical models that often involved things like option pricing theory. And on the other end, you had participants who took maybe, call it a more simplified and less mathematical approach that maybe involved taking an overall view of the equity value of the company and then allocating that value down the investment structure waterfall. And by the way, both of these approaches can have merit depending on the facts and circumstances. And certainly these are two approaches that we apply ourselves in valuing these types of instruments. But fortunately, over the past few years, I think we've seen some further alignment in terms of how to value these types of instruments. And as Eric was mentioning earlier, there's also been some very helpful industry guidance put forth from the AICPA and some others that have really illustrated and gone to a much further length, I think, than we've ever seen before in illustrating how to go about valuing these types of complex instruments. But I think as we see, in particular, these more types of complexities in traditional private equity, I think it will continue to take some more time for the sector to adapt and evolve when it comes to seeing more consistency in the approaches to valuing these types of positions. A second area that continues to present challenges, and certainly this is something that we saw throughout COVID, is asymmetry in reporting between underlying portfolio companies. And I'd say we tend to see this in particular in portfolios that are geographically diverse, where the underlying portfolio companies may adhere to different reporting requirements in different jurisdictions, where in some cases there may be a more significant lag in terms of when financials are actually delivered, and comparing that to your given measurement date. But even beyond the trailing financials, it can go into a lack of forward-looking information. And again, that's something that we certainly saw during COVID. And in fact, if we go back to Q1 of last year, as we were facing the onset of COVID in the US, we really saw this issue in the extreme, as there were numerous portfolio companies, often those in sectors that were facing some of the greatest level of impact from COVID, where the financial forecasts quite simply were just no longer valid or reliable, given the magnitude of impact that the business was facing from the pandemic. So these are real challenges, but despite differences in the level of information available for a given portfolio company, at the end of the day, the requirement is the same. That is, that we need to estimate fair value as of the given measurement date. And often this is where there's an inherent level of subjectivity and really professional judgment that is required in order to update the valuation. And in certain cases, you really do have to do the best that you can with the limited information sets that you have, maybe looking perhaps to peer company performance trends, and maybe some more qualitative assessments of your subject company performance relative to your expectations in order to adjust valuations. But again, this is where judgment is definitely required, and it can be quite challenging.
Yeah, no, I mean, obviously I agree with a lot of the sentiments that Joey just had. Obviously, as things become more complex and as investments become more complex, and as, managers, as Sculptor has obviously been doing this for a while, but as managers sort of move out of, very specific silos, and they move, across geographies and across different sectors, and maybe into even just different parts of the cap structure than maybe some have been in the past. the complexity on the valuation side is going to increase, and sort of building on what we said earlier with the fact that the expectations of what we do as the valuations team have gone up from LPs as the instruments that we're potentially investing in as a firm become more complicated. So it sort of forces us to look beyond what just we've been doing in the past and sort of expand our own horizons a little bit and start to understand these different structures, different areas. Obviously, different accounting systems, and as Joey mentioned, just different levels of information can certainly make things more complicated. In addition to that, I think one of the things that we've noticed post-COVID is there's been a real differentiation between sort of the winners and the losers, both across sectors, right? I think everybody knows that, a large portion of, say, brick and mortar retail, right, has been hit pretty hard during this process, whereas, many areas of technology have actually thrived in the last, let's call it 15 months or so. As a result, you've had a real differentiation, and not just with outside those sectors, but if you own multiple companies within one of those sectors, there's real differentiation as well. Certain subsectors have performed stronger. So, it's being very keen on your comp sets, right? Making sure that when you're trying to value a company, you're looking at what the real similar set is, as opposed to sort of the broader set. Oh, it's technology. Oh, let's take a very wide breadth, because obviously, depending on what the company is, Apple and Microsoft may not be the appropriate ones for a comp set, even if they're both technology companies, right? So there's a lot more differentiation required given the sort of dichotomy we've seen. And also one thing in terms of information that has been very important to look through and really understand is the question of, say, with M&A, what constitutes a non-fire sale transaction at this point, right? We've obviously seen a lot of distress in certain sectors. So obviously we're going to look at acquisitions and try to understand the multiples involved or the implied valuation for certain types of assets. But at the end of the day, in accordance with the AICPA guidelines and ASC 820, we need an arm's length non-fire sale transaction, right? And it's really trying to dive into the details and understand, beyond if it's arm's length, which, obviously you'd hope that would be easier to understand, was this a real manifestation of the true value of the assets, or was this effectively a fire sale caused by COVID? Right. So I'd say COVID has forced us to really get into the weeds and really understand what we're looking at in the way that we always had in the past, but it forces you to do just an extra level of work to make sure that you really understand what you're looking at, because your information obviously is important, but it's only as good as the analysis that you could put into it. Otherwise, you just have a lot of facts which may or may not be pertinent for what you're trying to understand. So I'd say if I was going to call it themes, sort of, access to information, real rigorous analysis of that information, and also truly understanding the dichotomy between who the winners and who the losers were, both across sectors and within sectors, and being able to apply all that information appropriately.
Yeah, that's great. And I think that gives us a nice segue into how the future might look. So as the next piece of that, how do you see the process changing even over the next 5 years?
Yeah, so look, I think that this trend, or these trends that we've been talking about, towards enhanced controls, more robust documentation, increased transparency, I think these are all likely trends that are here to stay. But I'll say a couple things. I do think we may continue to see a shift toward more frequent valuation requirements for certain private investment portfolios. But I think it may be strategy or structure dependent. And for example, we've been seeing an increase in activity from interval funds and even mutual funds that are now investing in privates, but obviously tend to have more frequent liquidity opportunities and reporting requirements in turn. And certainly those types of, that type of frequency, those types of requirements can present unique challenges when you're talking about the valuation of illiquid investments. It's likely not practical to apply a set of procedures that you might apply on a quarterly basis to a portfolio and try to use those same procedures to value positions, if you have a new strategy or a new fund vehicle that requires, say, weekly valuations or even daily valuations. And so as we see these new types of fund strategies, new types of structures that have a more frequent valuation requirement, we're finding ourselves having, increasingly more extensive discussions with our clients to develop a process that, again, both meets the fair value standard, but is also practical and efficient for the given purpose. And I think this leads into probably another topic that really seems to be commanding more and more attention these days, which is this question of how to leverage technology to design and execute a more efficient, more effective valuation process. And whether that's from the way that data is exchanged to workflow management, looking to automate certain aspects of the valuation itself. These are all hard feats to accomplish, just given the nature of private investments. And, again, as we were talking about earlier, the increasing complexity that we're continuing to see in terms of investment structures. And maybe the other thing, just the inherent subjectivity involved in valuing these types of instruments. But I think that technology certainly will be a key focus area going forward. And, we are definitely seeing market participants across the spectrum investing more time and resources in seeking tech-enabled solutions. And maybe the final point I would make here is that we are also beginning to see the arrival of credentialing and standards in the valuation profession. And that's mainly been through the recent development of two credentialing frameworks. The first is CEIV, which stands for Certified in Entity and Intangible Valuation. And the second designation is CVFI, which is an acronym for Certified in the Valuation of Financial Instruments. And apologies for the alphabet soup here, but both are effectively similar to a CPA designation with requisite exams, continuing education, peer review, and these were developed in response to really regulators acknowledging the need for a more consistent framework, more consistent standards in the valuation profession in this era where financial reporting continues to shift toward a fair value basis. And I would just say at Duff & Phelps, all of our U.S.-based valuation professionals at the manager level and above have either already obtained or are in the process of obtaining one of these two credentials. I think we're seeing similar adoption across the industry, and it will also be interesting to see whether we'll see these credentials eventually become a requirement on the fund side as well for fund professionals who have a responsibility in the valuation process. But let me pause there and see. I'm sure Eric has thoughts on the future of this topic as well.
Yeah, obviously, Sculptor, as a publicly traded company, has certain filing requirements that we have to meet. So we were never quite on that annual track, like apparently some of our competitors were, which sounds like it would have required a bit less work, at least for the first 9 or 10 months of the year. So I would say, and obviously we have some funds that may even need to be more than that pending. So I would say on our side, we've already been doing this more frequent. Now, hopefully we won't get to the weekly reporting, although I suppose if that ever became the norm, we would find a way to adapt. My guess is that you are probably going to have a trend towards more frequency. My guess would be that it would be more towards a, if you're annual, maybe more towards quarterly. I don't know for private investments if there's a lot of utility in weekly, pricing. You'd hope that they weren't changing that much, but, certainly, monthly is something where we might look at that for certain aspects of our portfolio as we do have, different liquidity classes. So that is something that we spend a lot of time on. And since our process is fairly regular, we can avoid any issues that you might have around sort of the stale valuation that you might have with, say, an annual process. I would say that LPs are consistently demanding greater detail and greater transparency. My guess is that is a trend that is not going to change. I think LPs have found the level of reporting useful. And they like to better understand the process because in some cases LPs have their own responsibilities, and therefore they need to really understand what's going on. And to be honest, I think that's a good thing that people are taking that very seriously and taking their responsibilities ever more seriously. So I think that's a trend that's unlikely to change, and I agree there's going to be greater and greater need for understanding what the LP requirements are and really understanding their needs in this area, so that the funds continue to provide them. The use of technology, and I'm not going to sound too much like a Luddite here, but obviously I think technology's role is only going to grow in the area. On our end, we have found technology very useful on the public side. In terms of being able to analyze a lot of data that is coming through. And obviously we are utilizing it on the private side, especially on portfolio levels and also for certain individual valuations as well. But as Joey said, there is a need for sort of human intervention in private valuations. And the reason for that is, a lot of it comes down to professional judgment. Right? And that's where you have to count on the fact that when you have enough layers of review, when you have a transparent enough and well-established enough process, when you have an independent valuation committee that can really, take a step back and look and really understand if things are moving in the appropriate direction, which is something that obviously we take very seriously. When you have all those factors together, I think that's probably the most important thing when it comes to private valuations from the fund and also the LP perspective. But I do expect, as technology sort of improves and the needs of the industry itself sort of evolve, that technology will play a greater and greater role. But the need for human sort of analysis and judgment in privates, at some point I would say, that does put a bit of a ceiling on it compared to maybe certain other areas within funds where I'd say there more automation would be.
Yeah. Okay, great. So I think just based on our timing, it's about 10:15. I think it's that towards the end of our session. We did have one question that has come in. I don't know if we'd be able to hit it given the time, but we will respond directly to this, to your question after the session. So thank you so much for everybody for dialing in. We really hope that you enjoyed the discussion today, and we hope that you have a wonderful rest of your day. Thank you. Thank you, Eric. Thank you, Joey.
Thank you. Thanks very much.
Great.
Thank you very much.